Hello everyone, happy Friday. Today on the final bar, we're going to wrap this week. A lot of movements to talk about, particularly today with the S&P and the NASDAQ pushing to the upside. The NASDAQ composite leading the way higher, up over 2%. Is this the beginning of a broader recovery? Ladies and gentlemen, this is the final bar. Hello everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we try to make sense of these markets using the best practices of technical analysis. The technical toolkit is really designed to help you better understand market dynamics, to learn the lessons of market history, to focus on what we're seeing now in terms of trend and momentum, breadth and sentiment, and how that relates to previous market cycles. The markets provide a fantastic history lesson. I think the charts are one of the best ways to try to learn those lessons and anticipate what may be coming next. So we're in sort of this interesting phase of the calendar year, right? We're now in May, which is the seasonally weakest part of the year, starting May through October. May actually tends to be a pretty weak month in an average year, but particularly in a pre-election year, which is where we're at now. So with that as the backdrop, a choppy week, a Fed week, finishes with the markets resolving to the upside. The S&P and the NASDAQ actually pushing higher quite a bit. We had some really good conversations this week with Ms. Schneider, with T.G. Watkins, with Julius DeKempener. Hopefully you saw some of those interviews. If not, you should go back and check them out. Ms. Schneider and I particularly talked about this potential rally into the end of the week. So we'll see what we can debrief on as we get to our Wrap the Week segment. And we do want to start with a poll. We always have a poll running on our live stream page at StockCharts.com, also on our social media accounts, so don't be afraid to give us a follow wherever you see StockCharts and StockCharts TV. We asked you recently, will sell in May and go away be good advice for investors in 2023? I'm not sure what I was expecting here, but 60% of you actually said no, implying that buying in May or not selling in May is probably a much better take. Only 40% of you actually suggested that sell in May would be a decent bet here. What's so interesting is in a pre-election year, sell in May actually tends to be a pretty decent strategy. And what you have to remember is it may not necessarily be the fact that the markets go down on an absolute basis, but relative to the other 6 months of the year, that's what's been pretty probable as a likely scenario. So does the market continue to go higher, but then the pace just lightens up and we slowly drift higher? Possible. I'd have to see the VIX remain relatively low, and today we're seeing the VIX move back down after jumping pretty high over the course of this week. Thanks for answering that question. Hopefully we'll have Jeff Hirsch on the show here pretty soon. I think we're going to get him on here in the next couple weeks. Let him weigh in on the sell in May phenomenon and where he sees things potentially going. Let's continue on with our Wrap the Week segment. We like to do on Fridays, just check in on what happened in the course of the markets today. Let's focus on some price action. Then we will look at some of the longer term movements over the course of the week, see what we learned about this market over the last 5 trading days. As we zoom in, you're going to see a lot of green here. The S&P up almost 2%, finished the day about 1.9% to the upside. That's after pulling back in the last hour, which may be an actually interesting data point when you're thinking about what to make of the day today. You can see just the last hour of trading there on the far left side of my screen. That's the last hour. And the last hour is interesting because that's usually when a lot of institutional volume will be had. Earlier in the day is when it's a little more retail-dominated volume. So institutions at the end of this day pretty happily taking profits is the way I would generally describe what the price action may be telling us. What is very interesting as well is the NASDAQ leading the way higher, 2.25% up for the NASDAQ composite. Mid caps and small caps all up as well. You can see the mid cap S&P 400 index up about 2.1%. Small caps, the strongest on the list here, up almost 2.4%. The only red you see is in the VIX. The VIX is teasing 20. It was just above 20, I think, yesterday when we were doing the show. All of a sudden dropping like a rock today, down almost 3 full points to finish today around 17.2. So what's interesting is this is, I would argue, at the very least, a huge mean reversion. If you look at what was really working today, it was something like energy, financials. Technology has been working overall, but financials and energy have been two just dog areas of the market, pushing to the upside today. Some of the underperforming sectors have been some of the strongest so far this year. Healthcare, consumer staples, which have had some really strong charts in there as well. So certainly at the surface, before we dig into the charts a little bit further, I'm sort of thinking of this as a mean reversion day until the charts tell you it's something more. And I think that's an important sort of disclaimer to keep in mind. Let's look at the yield curve, which overall all in the green. And what that means is bond prices moving lower. The yield curve, which is basically yields are the inverse of what you see with bond prices. And so when prices are going lower, yields are going higher, interest rates are going higher. The short end of the curve came up a little bit. It was really more the long end of the curve. So investors selling treasury bonds, that's bringing yields up quite a bit. You can see the 10-year yield right around 345, the long bond yield around 376. Of course, we still have that inverted yield curve. Now, that has been in place for quite some time, often a great indicator of a recessionary period. What's interesting is even if we are in a recession, however strongly you feel about that recessionary label, the markets can have a lot of significant movements even during that period. So as always, I think focusing on the charts will serve you pretty well. Dollar index, not too much of a change from yesterday to speak of. Interesting movement in the commodity space, right? One of the general themes we've been talking about now for quite some time is the strength in gold and silver, right? Sort of the precious metal trade, the weakness in things like crude oil, natural gas at times, showing weakness to the downside. Again, the opposite is what we saw today. Gold and silver, the GLD and SLV, both down about 1.5%. Crude oil prices up about 3 to 4%, depending on what indicator and what vehicle you use to measure that. Crypto land, all in the green. You see Bitcoin prices up over 2%. Ether prices up about 6%. Ether getting very close to that 2,000 level, which is a big round number. There's no real particular meaning outside of the fact that it's a big round number. And if you look back, there's been academic research that's been done on why markets tend to turn and tend to fluctuate heavily and tend to gravitate. There's sort of a pivot point naturally around big round numbers. If you Google it, I hope you'll find some interesting academic research that backs that up. But that's been shown, and what's interesting is it keeps coming back. So Ether below 2,000 versus Ether above 2,000, I think are two very different charts. Right? There's a different sentiment when we can get to a 2,000 handle and continue to push higher. Bitcoin getting closer to 30,000. It's a level it had broken above. It's been below it now for a little while. Do we get enough upside momentum to go back up there? So also worth noting, we talked with some of our guests, I think with T.G. Watkins and I, we talked about the relationship between stocks and cryptocurrencies often have moved together. That's become disconnected at time recently. Today, you're seeing both of them move together, sort of bonds lower, stocks, crypto higher, and that's sort of the general theme that I would describe to today. Just to talk about sectors very briefly, and then we're going to go into the weekly returns. Energy, the top performing sector, up 2.8%. Technology up 2.5%. Financials up 2.4%. Those are your top three sectors. And again, what's interesting by my read is that two of those sectors, energy and financials, have been two of the worst, if not the worst performing sectors year to date, right? You've seen a lot of weakness in financials, of course, with the banking crisis, the ongoing banking crisis. I'm pretty confident in labeling, and also energy, right? On crude oil prices that have been pretty consistently weak. You've seen energy stocks breaking down, not breaking out. The inverse is what we saw through the course of the day today. On the downside, some defensive stuff at the bottom of the list. Utilities still up 0.6%, but underperforming the S&P, as I mentioned, up about 1.5 to 2%. The different major benchmarks. Let's look at the wrap the week chart. So this is a simple chart that just starts the clock at last Friday's close. We end the clock at today's close. What happened with these major market averages? Follow my mouse, follow my voice, and you'll get a sense of where things are at. This is the S&P 500 in black, which was down about 0.8% from last Friday's close. A couple things underperformed in red. We have bond prices, the TLT, which finished the week down 1.2%. So what's interesting is stocks and bonds both about the same, right? Down about 1.25% for the week. Down here we have crude oil prices, which again rotated higher. And again, what I would argue is a mean reversion move from the deterioration we've been seeing for quite some time leading up into Wednesday's session. Had been down over 10% for the week. Recovered quite a bit of that, but still finished the week down 6.6%. Everything else outperformed the S&P. We have small cap stocks and the US dollar, both down about 0.4%, just narrowly in the positive. With today's rally, the NASDAQ 100, the Qs finished up just 0.1%, so essentially unchanged. Again, with today's rally, really solidified that. We have emerging markets and Bitcoin both up about 0.7% for the week. And the top performer, even with today's pullback, was gold. The GLD was up 1.4%. We've talked about the strength in gold stocks in our scooter rankings, the StockCharts scooter rankings. 2 of the top 10, if I remember right, maybe 3 are gold names, which is pretty unusual. It's not happened very often. So continue to see strength there again, even with the recent pullback that we saw there. I want to go back to our dashboard and just look quickly at some of these key big picture charts. I tell you what, let's start with the FANG stocks, right? When you think about the movements in some of these names, just the course of today, you can see Apple having a very strong day. And I was interviewed earlier today with CNN. We were talking about this narrow leadership challenge and what to make of it. One of the things we talked about was one of the 3 and 3 charts we shared on the show yesterday, which was equal weighted technology versus cap weighted technology. 2 of those sort of mega cap tech stocks are here. Apple up 4.7%, Microsoft up 1.7%, NVIDIA, of course, in the tech sector as well, up 4.1%, Adobe up 3.7%. That's just today. Apple having earnings. You know, why is Apple up so much? Well, iPhone sales, 100%, I get it. That's encouraging. I would argue the fact that they also announce a decent corporate buyback, buying back some of their shares, that is sort of I don't want to say artificial demand, but it's certainly not the free market forces telling you Apple's worth more. That's the company taking some supply out of the market. That means what's left is probably going to be worth a little bit more. So for whatever reason, Apple up almost 5%. That's a pretty decent update. Other tech names up as well, with some semiconductors that have been struggling a bit here recently. Moving back to the upside again, NVIDIA up 4% is no joke. Down at the bottom, let's just check in on some of these big picture measurements of trend over the course of recent weeks. My market trend model, which looks at 3 different time frames, long-term, medium-term, and short-term, still all in the green. Earlier in the week, the short-term model was dipping negative. I don't update this model formally until Friday at the close, so it's just reviewing it. Again, I'm assuming nothing dramatically changes as we process the last sort of closing bits of data, make sure we lock in the official closes. But overall, it looks like my short-term model will remain positive. That is all about today having this decent rally. Had we not had that big bounce higher, it would have been the short-term model turning negative. So for me, it's telling me still bullish on all time frames. And again, I can't disagree with that, is what the benchmark has been doing, right? If I visually just assess what's the trend over the last couple weeks, the last couple months, and the last couple years, I would say positive in all of those time frames that I just mentioned. That's what that market trend model is meant to capture. You know, looking at the chart, and then we have to wrap up here for a break. Notice the difference between the S&P 500 really still testing the February highs and the advanced decline line on the New York Stock Exchange. When we talk about the downside, right? What are the concerns when you have narrow leadership? It's that the average stock is not looking nowhere as good as the mega cap names. I think that's a concern. A lot of these breadth measures still kind of neutral. So if the market is bullish from here, I would need to see more improvement in some key measures of breadth. Let's take a quick commercial break. We'll be back answering some of your questions from the Final Bar mailbag. We'll see you in a minute. Hi there, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We are so excited to be coming to you from our studio here in Redmond, Washington. Boy, the studio got a lot of use this week. We had some really fun conversations in this space over the last couple days. A lot to think about, and hopefully a lot of good ideas and thoughts to spur your own thinking as you are using the StockCharts platform. We're going to get to the mailbag here in a few moments, but I did want to make a couple quick announcements. First off, the mailbag is all fueled 100% by people like you sending in your questions. What are you running into as you are trying to analyze the markets using technical analysis? Email us your questions at thefinalbar@stockcharts.com. You can hit us on Twitter at FinalBarSCTV. Put a comment below the video you're watching on our StockCharts YouTube channel. We would love to hear from you. We'll hope to answer your question on Monday's show, our next mailbag. Upcoming schedule. We had a fun time yesterday recording Charting Forward. It was a wide-ranging discussion. We hit on a lot of different asset classes. We laughed a little bit as well. It was a really fun group. We had Miss Schneider, T.G. Watkins, and Julius DeKempener, my 3 guests this week, all in the set together. It was great. It was great fun. I hope you enjoy that on Monday at 11 a.m. Eastern. On Tuesday, we have Jay Woods of Freedom Capital Markets joining us from New York. On Wednesday, the 10th, Frank Capilleri, founder of Cap Thesis, longtime sell-side technical analyst with some really interesting charts to share as always. We'll be talking with him on Wednesday. Let's keep it moving with our final bar mailbag. Again, thanks for all of your great questions. We're going to answer a couple of them here. Let's get to question number 1. Dave, is the 2022 bear market an ABC down move where the October low ended wave 1? I love your question. My short answer is I don't know, but I will give you the longer answer here in a few moments. And I say that because it was funny when we were talking yesterday for Charting Forward. Mish and TG and Julius and I were chatting as we were just prepping for the show, and Mish made the comment. It's so refreshing when someone actually says I don't know or I'm not sure. Here's what I want to dig into to try to understand that better. So Elliott wave is what you're implying, right? Which is basically, is this a big wave A down, and then a big wave B up, and then a big wave C down? And I would say probably the weekly chart of the S&P is going to be a better way to probably visualize that. So if you take the big move higher, however you want to count this, you're basically, I think, suggesting, is this a big A from January down to October? Then we're in some sort of wave B here, and then we have a big wave C going down. The short answer is maybe, right? And I would say my conversation with Jeff Hughes comes to mind. If you look back to the last time I had him on the show, we did talk a little bit about his wave count, actually 2 visits ago, which I think was early on in 2023, but I don't have the date in front of me. I know Jeff talked, we shared a particular chart with his bearish wave count, and he is loosely, I would describe his take as kind of what you're saying. He sees this as the beginning of something deeper. This is the recovery off of that first wave down. And then we have a big third wave down. What's concerning is the general way of thinking about price measurements, if it is an ABC pattern, is basically this leg of the move would need to be continued on the way down. And the simple way I would do that on stock charts is use a trend line. If you want to get really cute, you can make it an arrow and make it a nice thick line. We can make it this color. So take this, which is sort of that initial wave. Then you can actually just move it over and you get to see like how far down that would be, right? So if we take it from here, the timing isn't as important as it is taking it from that level. And that basically gives you a downside target around 3,000 to 3,100. That's if we've locked in the peak, if we don't get any higher and that we've already started the wave C, or if we sort of begin from here. So that's what gets you to sort of a downside target. Now, what's interesting, and I think what compelling talking with someone like Jeff is, it's not like we're just going to go from 4,100 down to 3,100 overnight, right? There's a process by which we get from point A to point B, or in this case, point B to point C. So I would be looking to see if we get confirmation. Getting below moving average support, failing to hold price support, those are all things that would happen well before it would be really clear that there's a wave C. So the short answer is that is very much possible. That would give us a deeper downside target. Jeff Hughes did a really good job in his last appearance here. He also is one of the frequent guest hosts on Your Daily 5. I would check out his most recent contribution there as well. Let's get to question number 2. Would it make a difference if RSI used exponential moving averages instead of simple moving averages? You're bringing back a painful part of my own history as an analyst, which was what they did at Bloomberg when I joined there in the early 2000s, and you were learning technical analysis. Was basically we had to recreate pretty much every technical indicator we had on the platform in Excel. So we basically had to take raw price data. And the challenge was, okay, prove out RSI and show me what the numbers mean. And thanks again to my boss who kindly asked me to do that, because I learned a ton, right? I learned how much I do not like spending all my day in Excel, but I also learned a great deal about the construction of indicators. So the short answer to your question is that's actually incorrect. The RSI actually uses an exponential calculation, and it's kind of confusing. This is one of those really annoying parts of how technical analysis has evolved, in my opinion, because when it says RSI 14-day, here's what that actually means. And I've argued with Tom McClellan many, many times about this, and we actually are in agreement. So I guess arguing together on one side of it maybe is a better way to put it. What that means is on your initial calculation, so years ago when you start the calculation, you do look at 14 days, and you're basically saying what's the average up day and the average down day for the last 14 trading days. So the first observation is a simple average, but every subsequent observation actually begins the exponential calculation. So instead of doing a rolling 14-day window, you actually are incorporating additional data, and every new data point has a certain percentage weighting. So Tom McClellan and the McClellan, his company, in their reports, they actually refer to it as a percent exponential moving average, like a 5% or 10% exponential average, because he feels that that's a better way, a more compelling or a more understandable way of what an exponential calculation is actually weighting. That is a long-winded, math-heavy way of saying basically it does use an exponential average, and I think there's a very good reason, because it's just much more reactive. When the market moves quickly, simple averages don't change a lot because they're equally weighting what just happened with something that happened 50 or 200 days ago. An exponential calculation really focuses on, it's much more sensitive to what's happening. So any trading system I would use driven by moving average, most likely I'd be using exponential averages exactly for that reason. If everything I said does not make sense, I will point you to two places. Number one, click the little magnifying glass, type RSI, and look for our Chart School articles on the Relative Strength Index. We'll show you the formulas that we use. You'll see the exponential calculation that I just maybe poorly described. On my YouTube channel called Market Misbehavior, I recorded a number of videos about exponential versus simple averages, and I would encourage you to check that out as well. Next question. At what level do you consider the put-call ratios to actually be bullish or bearish? And yet a much longer question. I appreciate you sharing, talking about how the put-call ratios are just slightly below 1, which is usually a contrarian, bullish, or neutral signal. So what's your take on it? So first off, as I mentioned, if you want to know more about the put-call ratio and how it's calculated, what it actually means, click on the magnifying glass, type put-call ratio, get to this article from our Chart School, which is a free section of our website, really is designed to help you understand it. But what I can also do is look at the put-call ratios. I have them in a sentiment chart list along with things like the VIX and other things. We'll maybe look at this one. This is the total put-call ratio, so it's looking at index options, equity options, all kind of pushed into one. This is the standard put-call ratio I think a lot of people refer to, although sometimes they'll say the equity-only put-call ratio. We have that as well. It's just $CPCE if you want to check that out. As you, I think, implied in your question, it's rotated around the 1 level, which is absolutely right. And for the last 12 months, if not a little more, that's absolutely been the case. Here's the thing about the put-call ratio, and it's the same issue that you have with the VIX. You can talk about a specific level like 1, or on the VIX like 20, but you have to remember that sometimes the VIX will get way, or the put-call ratio will get way away from that average level. Look back in the second half of 2020 and the first, really the entirety of 2021, you'll see that the put-call ratio rarely got anywhere near 1. It was actually well below that, right? And that implies just the general way that investors are betting, right? This is looking at volume on the put side versus the call side. And if there are more puts than calls, it goes higher. If there are more calls than puts, it goes lower. Now, that as a sentiment indicator is making a lot of assumptions about what that ratio actually represents and what the volume on the put or the call side really represents. The other concern I have about the put-call ratio is something we've talked about with the VIX. Here you see where the raw data, which is in gray, gets really, really noisy. And this is in the fourth quarter of last year. This is when the 0 days to trade expiration options were released and really became more and more liquid. They're now the most liquid parts, or the most heavily traded part of the options market right now. And that really spiked the put-call ratio way up to the upside. And arguably that's more an artificial side effect of this new option type that people were getting used to. Now we've seen the raw data settle in quite a bit. You're still seeing the put-call ratio rotate around there. So the short answer is 1 is about even, and I would say when the put-call ratio is right at 1, I think that's like an RSI at 50. It's sort of like we're kind of even, right? There are puts and there are calls and they're about evening out. What you want to look for is when there are big spikes, right? A very high put-call ratio usually coincides with market bottoms. A very low put-call ratio usually coincides with market peaks. So the fact that we're right at a neutral level basically tells you it's not telling you much about the current reading on the put-call ratio. Great question. Last one. What is the point of the accumulation distribution line if it just follows price? I love the cynicism, but in a nice way in your question, and thanks for sharing this. Again, I'll point back to the magnifying glass type accumulation distribution line. You'll get to this article in our Chart School pages, really talks about this indicator created by Mark Chaikin. If you don't know the accumulation distribution indicator, it's similar to another indicator he created called Chaikin Money Flow, which I would argue is a brilliant upgrade to raw volume, and even also an upgrade to on-balance volume, which was Joe Granville's design to try to make volume a little more directionally meaningful. Mark Chaikin made some more improvements by looking at the range where the stock actually is during a range and weighting the volume that way. And then the question that you sent me actually pointed me to this particular part, which is saying how helpful is this if it just confirms the trend, right? Here's the raw data, the bar chart, and then in pink it's the accumulation distribution line. You can see it's trending upwards as well. So the reality is that's what is supposed to happen usually, right? Most of the time, if the market is sort of quote unquote normal, right? If it's just sort of doing what it should normally be doing, it would make sense that the accumulation distribution line is going up, because what it's actually measuring is the volume on the up days versus the down days. And not just if it's up or down, but actually showing how much, right? If the stock is up a lot, how much volume on the up a lot days versus the up a little bit days. And this accumulation distribution data is basically looking at the trend in the stock, but weighted by volume is another way to think of it. But if you go a little bit further down in the article, you get to the really good stuff, which is when there's a divergence. And I would argue most of the time, the accumulation line should look like this. Some of the time, it actually looks like this, which is where there's a divergence. The price goes lower, but the AD line actually goes higher. The price goes higher, but the AD line slopes lower. Think of it like RSI, right? A momentum divergence just tells you that something is different. And the accumulation distribution indicator is often a much better gauge because it looks at the volume, basically saying we've been selling off, but now the volume's totally drying up. This is most likely at a bottoming phase. So I would encourage you to read a little bit further in that article where it talks about divergences, and then you'll see how most of the time, you're right, it should kind of move in line, but that makes sense. The times when it doesn't is when there's a real signal potentially in that indicator. Really thoughtful questions, you guys, and thank you so much as always for sending those in. Keep them coming, but we have to wrap the show and go to the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment, and here is chart number 1. We talked about our market trend model in our Wrap the Week segment. Again, what's so interesting, we had so many narratives happening through the course of this week. And I know talking with my guests on Charting Forward yesterday, we were sort of trying to get our head around all these different things, right? We talked a little bit about the debt ceiling, but we didn't even get there because there were so many other narratives to try to unpack and try to understand. At the end of the day, how do you cut through the noise of the macroeconomic environment, all the Fed, bank crises, geopolitical issues, war happening in different parts of the world? I would argue the best way to cut through all of that is by looking at the charts, thinking about the trends on different time frames, because that is what's showing you how investors are actually internalizing all of that stuff and placing their bets. What bets are they putting on the table? This is what charts are really telling you and really measuring. When I'm looking at the market trend on 3 different time frames, it's still positive. It felt certainly up until Friday's session that the short-term model was going to turn negative. It certainly was leaning that way. The rally going into this weekend changes a little bit that short-term dynamic and basically says we're still okay. And what that tells me is to not be afraid to be looking at long ideas and certainly to be sticking with trends that have been working. That's why charts that have been working in technology and home builders and gold stocks and healthcare and all those areas of the market we've talked about, I don't see anything on those charts necessarily yet, broadly speaking, that are negative, and I think the market trend model confirms that. The short-term model turning negative, which at earliest would be next Friday for me, would be the warning sign. That would be a red flag that maybe things are changing. Not yet. Chart number 2 just was taking a step back, thinking about year-to-date returns here, and we think about the relationship between things that have been working and things that have been not. Year-to-date, with today's rally, the S&P finishing the first week in May here up 8.3% year-to-date. Not a bad start to the year. Again, as I'm thinking of the backdrop, I saw Jeff Hirsch in New York last week. We were talking about seasonal tendencies. We're now in a weak month, right? May does not tend to be fairly strong for stocks. So that is the backdrop that I have in mind as I'm looking at these charts. But we have home builders in purple, we have gold stocks in blue, and we have technology in green. And all of these are up way more than the S&P. So why is the S&P not up more? We have things like energy. Even with today's bounce, it's still down 7.3% year to date. Those counter trend moves I think we saw today from energy and financials, not enough in my opinion to declare a change of character just yet. Speaking of a change of character, though, I think you're seeing an increase in bearishness, which is fascinating to me with how the markets have been holding up okay. The S&P, the NASDAQ testing resistance. Again, this was completed yesterday, so it didn't include today's rally. But as through yesterday's close, we're down at 45% bears in the AAPL survey, almost double the number of bulls. Those are not bull market readings for that particular indicator. Folks, that's a wrap for this week. Thanks so much for joining us every weekday after the close for the final bar. Great conversations this week, all for free at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a good weekend.